This LOS is describe the use of financial statement analysis in screening for potential equity investments. Continuing with financial analysis applications, now we're looking at screening for potential equity investments. Ratios constructed from financial statement data and market data are often used to screen for potential equity investments. Screening is the application of a set of criteria to reduce a set of potential investments to a smaller set having certain desired characteristics. Criteria involving financial ratios generally involve comparing one or more ratios with some pre-specified target or cutoff values. Top-down analysis involves identifying attractive geographical segments and/or industry segments from which the investor chooses the most attractive investments. Bottom-up analysis involves selection of specific investments from all companies within a specified investment universe. So growth investors looking for high PEs, for example, value investors looking for low PEs with their screens. So here's just an example. The table below shows the results of applying the screen in August 2010 to a set of 5,187 U.S. companies with market capitalization greater than 100 million, which compose a hypothetical equity manager's investment universe. So you can see that we have the criterion on the left-hand side, the stocks meeting the criterion, and the percentage of the total. So the first criterion is a PE less than 15. 1,471 stocks meet the criterion. The set is 5,187, so 1,471 divided by 5,187 is 28.36%. Total debt divided by assets, so debt to assets, less than or equal to 0.5. 880 stocks met the criterion, which was 16.97% of the total. Net income divided by sales greater than 0, so that's positive net income. 2,907 stocks met that criterion out of 5,187, so that's 56.04%. Dividend yield over 0.5%, so looking at companies that pay some dividends. Stocks meeting that criterion, 1,571, which is 30.29% of the total. And so then we can look at the number of stocks that meet all four criteria simultaneously. That's only 101, which was 1.95% out of the 5,187. So in this case, we looked at four screens, the number of stocks that filter through, and then a filter for number of stocks meeting all four criteria. We start with an investment universe 5,187. If these were the four criterions that we wanted for a focused fund, we'd have 101 stocks left to be considered. Just a quick little practice question here. When a database eliminates companies that cease to exist because of a merger or bankruptcy, this can result in A, look-ahead bias, B, backtesting bias, or C, survivorship bias. I think that's an easy question. C is correct. Survivorship bias exists when companies that merge or go bankrupt are dropped from the database and only surviving companies remain. Look-ahead bias involves using updated financial information in backtesting that would not have been available at the time the decision was made. Backtesting involves testing models in prior periods and is not itself a bias. Another practice question with regards to screening. One concern when screening for stocks with low price-to-earnings ratio is that companies with low PEs may be financially weak. What criterion might an analyst also include to avoid inadvertently selecting weak companies? A, net income less than 0, B, debt to total assets ratio below a certain cutoff point, or C, current year sales growth lower than prior year sales growth. I think this question was pretty easy because if you look at A, net income less than 0, well, that would be a weak company potentially, and current year sales growth lower than prior year sales growth, that would look like a weakening of a company as well. So B was correct. A lower value of debt to total assets indicates greater financial strength. Requiring that a company's debt to total assets be below a certain cutoff point would allow the analyst to screen out the highly leveraged and therefore potentially financially weak companies. One last practice question to finish this LOS. When screening for potential equity investments based on return on equity, to control risk, an analyst would be most likely to include a criterion that requires A, positive net income, B, negative net income, or C, negative shareholders' equity? Again, I don't think that question was too difficult. A is correct. Requiring that net income be positive would eliminate companies that report a positive return on equity only because both net income and shareholders' equity are negative. And that's the last slide for this LOS. Thank you.